Good evening. Welcome, everyone. Welcome to the Market View commentary for Monday, the 10th of February, 2025. I had a really good question or three come in over the weekend. And the question was basically, how do you fight? I could have made more in this, and I could have made more in Meta because it was fully valued at $520, and today it is trading at, let me get a quick closed at 717.40. And good comment, Jim. I agree 100%. So we exited right around between 509 and 520. And the comment was, Kevin, it's almost $200 higher today. So on 500 shares of Meta times today's price. Actually, let's go back to the 520 price if I can do that. So if I'm looking at the Meta shares, and I'm going to do I'll do a clear 500 times 520. It was worth $260,000. So my question is to the group, if you had 500 shares a year ago and it was trading at 520, worth $260,000, what is your risk in that investment? What is your risk in that investment? If you had 500 shares, 500 shares a year ago, basically. I'm pretty sure it's a year ago. We're going to take a quick check. Let's go this way. But someone tell me, what is the risk Boy, it went all the way down to one point. It was down at around 415. All right, so what's that risk? There we go. That risk is, and I say it all the time, every freaking penny. The return on investment was 100% plus. And there's a key here that some people don't think about. And I think this is a very great opportunity to help you understand. You don't necessarily lose or gain anything until you close the trade. So when it was way overvalued at 520, ooh, Billy, I'm not saying that one just yet. It did, by the way, go down to like 411, which means you were down 20% on the stock at one certain time. But you don't necessarily lose or gain anything until you close that trade. You have to have an exit strategy for your positions. Not only does that go with stock ownership, not only does it go with option spreads and option trades, but it also goes with stock ownership. You should be preparing an exit strategy. There are plenty of other opportunities if you will do the work to find them. Here's the other side of this, and someone has half of it. My job is to make as much money as possible, taking as little risk as possible. That's my job. No one here has hired me to go gamble, to let it ride, to let it run. That's not what I'm here for. In fact, Stuart, if I can use Stuart, Stuart's made the comment to me, and I think he's on one of my websites, as Stuart calls me his conscience. I'm his conscience. I am the Jiminy Cricket on his shoulder that says and looks at some of his personal trading accounts and goes, Stuart, what are you doing here? Why are you doing that? What about this? What about that? I get to be his conscience to a certain degree. Obviously, he's making the choices, but we don't just let things ride. We don't gamble. We're always hedged. And I say always, but we prefer to be hedged in the times when big drops can occur. Now, I just made a comment. I'm going to say it again. We aren't always hedged, because that doesn't make sense. How often, what's the black swan percentage? Anyone remember? Black swan percentage. How often, how many trading days, what percentage of the trading days could a black swan on average occur? Anyone know? And I'm not sure what they call a black swan either, so this might be a weird one. But what percentage is that black swan? And I could be wrong, so no, take a guess. Take a guess. What do you think the percentage is of a black swan event happening? And some of you are probably going to your phone, right? Percentage of black swans depends on any standard deviations you consider a black swan. That is true. Swan stock market percentages on average. A black swan is often a market that crash that exceeds 6 standard deviations, making it extremely rare from a problematic. So I thought it was 3 0.6%. And that equals 6 standard deviations. And that was from Investopedia. So you would be protecting 99.7% of the time that you don't need protection. That just doesn't make sense, which is why we're not protected all the time. If you are protected all the time, usually and I did this calculation back in 2008, usually your stock has to go up at least 16.8%, up to as much as 27% if you want to be protected 100% of the time with protected puts. So the short answer, we got a phone call coming in. The short answer is when we book a big profit, 100% plus return like we did on Meta, we also create an stock, how do I say this? We do a stock replacement strategy. So that if we're wrong and the stock does continue to go higher, we have something in place that will continue to make a pretty good percentage of the upward movement. The cool thing about the stock replacement strategy is it gives you a much better return on investment and much less risk. It's interesting because we have a couple of you that are here that are new. We have a couple of you that are starting with us relatively recently. Let me see if Tanya's not here, but we do have a couple of you that are here with us that are recently new. And we do have a couple of you that are with us that came at the absolute worst time and have started with us. But our goals are this. We're trying to exit positions with a profit, and we're hedging that if we're wrong, we can still be in a profitable position at the end. And that kind of comes up to the second question that was asked, which I thought was really an ingenious way to think about this. You need to think of investing longer term. It's a process. If you're looking on any one single given day and you're upset, you're day trading and you're going to drive yourself crazy. One single day should never make or break your portfolio. It just doesn't. And I have a little interesting example here because a couple of you last week, and I'm just going to say last Tuesday, were a little ticked off that we capped Apple at $245. And I tried to make this explanation where I could show you, hey, it's too expensive to protect. It seems to be coming back. It's caught in no man's land. And all we did is say, hey, one of the most recent highs that it can't seem to get above, technically speaking, is 245. And last week we probably put it on one, two, three. So we probably put it on day, and then Tuesday we had this big up day. We looked at capping, and it was pretty easy to see. We looked at capping Apple above the 50-day simple moving average. And yes, for 3 days, Apple looked, oh, Kevin, how could you cap Apple? What if we sold out on Apple at 245? My goodness, that would be horrible. Apple's traded as high as almost 260. But it's between the 50-day and the 200-day. It's dropped down, didn't even take a day to plummet through the 50-day simple moving average. It was pretty concerning. We're not sure what's going on with Apple. But what we do know is that today the position is up $361. In fact, Apple was only up 2 cents. 300 shares made $6. 300 shares with our options made $118.50. All we did is looked at Apple and said, hey, if your cost basis is around 177, we might be okay with selling Apple roughly $70 higher. We're getting $4 of credit. On a day where Apple might only be up $6, geez, we made like 200% more than that on that option position. Net, we're up $361 on an option position. We don't know where Apple's going to go. But we did know, and we felt we needed to hedge, and hedge as cheaply as we needed to. If we took a $4 credit in, which we did, and have to sell at 245, it's like selling at 249. And it gives us some time while the market figures out taxes and Trump's first 100 days. It gave us a little protection that we could make a little bit of money with the uncertainty of what's going on. Don't be married to the stock. It's okay to get out of stocks, especially at a profit. You don't lose money by getting out of the stock at a 50% return or more. You lose money when you get out of stocks at a loss. You lose money in trades when you get out of stocks at a loss. I just wanted to bring up one other point. I showed this one probably about 3 or 4 weeks ago. And a lot of people were not understanding. So you've got to work your numbers. And I'm going to do it one more time. We bought to open micro strategies, right? At it's right here, $424.15 per share. Risk on the trade per share comes right back down to is every freaking penny of the stock, right? It can go out of business. It can go out of business pretty easy. We also sold to open a 16 January 2026, $420 short call for a credit of ridiculous credit, $179.15. Net debit. What was the net debit for us in this trade? Well, it's $424.15 minus the credit of $179.15, which, going to use a calculator so that we're all on the same page and so that I don't make a mistake. Four minus. It actually, well, it's right there. I can't believe I'm doing this. Our average price is listed right here, $245. $245. $24 are net debit, which is also our maximum risk in the trade. If I was to take 245 and divide it by the stock price of when we got in at $424.15, by selling that short call, we reduced the risk in the trade. Well, how would I say that? Yeah, well, I'll just say it. Making a mess of this. We reduced the risk in the trade by 43%. Could have paid 424. We only paid 245. So by getting into this trade, we reduced the risk of the trade by roughly 43%. Maximum return 420, where we get called out, minus our cost basis of 245. I think this is a ridiculous return, is equal to an even $175. Or if we take $175 and divide it by the total invested capital, we're going to get a 71.4% return on risk, return on invested capital, return on investment, however you want to do it. Our break even is equal to 245. In the first couple weeks we were in this trade, yes, we lost some ridiculous amounts of money. I get it. But our protection made us some ridiculous amounts of money. It's pretty neat when your stock can be down as much as $50 in a day, and you can make up over half of that. And we have a lot of time to make up a lot more in the trade. We're looking at a 71% return. We might at earnings put some out of the money long puts to play in case it doesn't do well. But right now, we're very comfortable because we're working the numbers. And even though it didn't look good the first couple of weeks, we're thinking in terms of a process. Investing for us is not a single day or a single event. It's a process. 3 weeks ago, you would have come to me and said, this trade looks like it's breaking even. 5 weeks ago, you would have come to me and said, this trade looks horrible. Today, you know, we're up 2,600 in a trade that has the ability to be up, has the ability to be up $175 times the 100, so 17,500 times 3 contracts. It's a $52,500 potential profit in a trade. We got the numbers we were looking for when we started this. And because of that, we're sitting really, really good. Not a concern on our side at all. And if you have a couple of these in your account, you now know why. All righty, here we go. Earnings dates. Only big earnings that's happening that we're paying attention to is Coke reports. A lot of our earnings are coming next week. With that said, next week, because it's President's Day, we will have the commentary will be on Tuesday. Next Monday is, pretty sure it's President's Day. Yep, President's Day. So after I'm done here, we'll change the commentary for next week to Tuesday the 18th. We will not be having our commentary on President's Day. I'll be in Las Vegas with Taylor doing some soccer. Briefing picture, very interesting. Once again, I don't get it. The worry about tariffs is that it actually will hurt American companies and it'll make American goods cost more. That is not correct. Tariffs that are going to be moved forward are for product that's made outside of the United States. I'm going to go ahead and I'm going to use Honda Accords. I'm going to use Volkswagens, your Beamers and Mercedes. Those will cost more. American cars, the Jaguars by Ford, those will not. If you're interested in I almost said a Cadillac there, in a, it's my dad's favorite car, a Corvette. If you like Corvettes, they should be coming down in price. Tariffs will force foreign companies that ship in stuff that we buy to have to make this in the United States. I found it very interesting because, again, it's very biased on how bad tariffs are, but for the first time it admits that not necessarily all scenarios are going to be true. There are scenarios of positive, negative, or even stagflation type of events with tariffs. I would suggest you go through and read this again. We didn't see huge price spikes happen the first time, which once again makes you think, how much do economists really know? All right. Where will the market end this week? We had a grade up day. I'm still on the lower side, and I think I just got it last week with Friday. We don't have a huge amount of information, and I'm not sure if good news or bad news, so I'll go over our economic events here in a bit. But our Dow is still bullish, barely. Notice how we're getting the crossovers on the MACD right on top of each other. So maybe a precursor to our market going down a little bit. S&P 500, we are still technically bullish, but not by a whole lot. We're bouncing off of the median line for the third time, almost like a triple top, a triple bottom. 54.73, 50 is a median line. We're awfully close. We are 64 points away from the 50-day. And boy, for a couple weeks now, the MACD has been on top of each other. And taking a quick peek at the NASDAQ. Technically, we are bullish on the RSI. I'm pretty sure we have a crossover, so technically we're bullish on whatever EMAs you're using, but we are not technically bullish on the MACD. A lot of people would tell me, well, we're bullish now. Technically speaking, we're not. We are not bullish on the MACD. The signal line is at 33.8. The red line is at 38.225. So technically speaking, we've had two crossovers on the NASDAQ, but we have not had our third. This is a great technical analysis example of 2 out of 3 does not mean that we're bullish. 3 out of 3 means that we're bullish. We broke through the 50-day last Friday, which caused Keeve and I some heartache and pain. Definitely need to be paying attention to your charts. We are still bearish on the NASDAQ. World S&P in February, we're still going to go with a negative 1%. Earnings, we had McDonald's today, it did pretty well. Coke and Energy Transfer tomorrow. Marriott, Humana, British Petroleum, DoorDash. Wednesday, we have Gold, the CME Group, Denny's, CVS Pharmacies, MGM Grand, Robinhood. Not a fan of the Robinhood platform. Only one that I think, well, they are the worst. The only one that's slightly above them is Schwab. HubSpot on Wednesday, Crocs, Deere, Duke Energy, GE Healthcare on Thursday. Tapestry, that is not Tapestry, that is Coors. Wendy's, Airbnb, Nu Skin, Roku, Twilio, and Wynn. Economic reports, CPIs on Wednesday, PPIs on Thursday. I don't think the market knows if good news is good news or if good news is bad news, or if bad news is good news or if bad news is bad news. So this will be a very interesting week. We do have some protection on from earnings and a little extra protection we added due to technicals in some positions. So we are going into this week mostly protected. We hope we're wrong because we like to pull some of this off. Wednesday will be a very big day for CPI. I found some interesting articles here. Deep Sea claims to shaking up the world, but not everyone's convinced. I have that in here for you. I have a very interesting article about the cyber attack and how quickly artificial intelligence was cyber attacked after it was this big thing. In fact, I even understood it was shut down for a period of time. So if this is the next greatest and whatever, the next greatest artificial intelligence, and it gets hacked within a couple days of this big announcement, there's some problems with it. There's some backdoors written into the software that should scare you. Ford beats earnings top and bottom, but expects a tougher year ahead. They're being punished for trying to figure out what they're going to do with their overseas, pretty sure it's Germany, China, and their Mexican factories. Tom Lee says, buy the tariffs, dip in the stocks, if Bitcoin has had for much more short-term pain. He's just a contributor to CNBC. In all honesty, I just put this in here because I like the dip in the stocks. Not sure if I completely agree with what he's going to be talking about. Google scraps their diversity aspirations, citing role as federal contractor. DEI is going to be replaced by merit systems at Google. Interesting article. Everscore ISI says buy NVIDIA for a trade later this month for their earnings. We also think their earnings should be pretty good. A couple of you has asked me, and this was brought to my attention. Hey, Kevin, you're in the Magnificent Seven because obviously for a couple of years now, they've been killing it. And yes, I've been in a couple of the Magnificent Seven, Apple, Alphabet, and Meta. Recently, we've been dipping our toes into NVIDIA. We have not been in Microsoft, have not been in Amazon, have not been in Tesla. And if Netflix, is that one? I'm pretty sure it's Netflix. And Netflix is one of your outliers here. We have not been in Netflix either. But yes, we know the Magnificent Seven is starting to weaken. We're not in all of them. We've chosen 3 of the best. And then also another deep seek, the military will not be using it because of security and ethical concerns. Again, if it gets hacked into a couple days after becoming something globally, that is not a great, that causes people to be scared up front. All right, so with that said, what questions do you guys have for me today, if any at all? And for Dave, who's going to make the quick comment, yes, I was disappointed in the Super Bowl. I thought it would be a much better game. I thought it'd be a shootout. I thought it'd be 56-49. That was an awful Super Bowl, but I must say I really did enjoy the commercials. So the commercials I thought were the best I'd seen in a long while. All right, any questions you guys have that I can answer for you? And yes, I can definitely, if something is weighing on your mind, obviously send me a quick email. I might call you on it. I might send an email back on it. If it's something that I think can help out the group, like this morning or like today, I'll go over some of those as a group so we can see what's going on and you can be a part of it. All right, I don't see anything coming in. So if we don't have any questions, I look forward to seeing you guys next Tuesday. I'll switch that as we end this tonight, but we're going to switch next week's on President's Day. We're going to switch that to Tuesday evening, and Tuesday night we will do we'll do our commentary. All right, hey, appreciate you guys. Thank you for your time. Look forward to seeing you next week. Have a wonderful week. Enjoy your 3-day holiday, which, yes, means that most likely big money will be out at the close of Wednesday, which is why the CPI numbers will be so important this week. All right, guys. Hey, appreciate your time. Look forward to seeing you guys next week. Have a good evening, and I'll see you then. Bye-bye.